Mark, and today we look into two different strategies, the Iron Condor versus the short Strangle in the XLF, the ETF Fund, Financial ETF Fund. So I hope you enjoy this video. We look first into the Iron Condor on XLF. So to explain you, this Iron Condor is nothing else that we combine a kind of call spread with a put spread on both sides. You can see here we are using the XLF as a kind of medium of 32.08, and what I did is now we sold a 32 half call and buy a 33, sold a 31 half and buy a 31. So in other words, that we expect that the price range of this XLF would be between 32.5 and 31.5. We see the credit, maximum credit is 28, so we receive 28 credit. The maximum loss is 22. As you see, we have here on both sides this kind of 50 or 0.5 difference. So in other words, we can lose a maximum of 22. And maybe what's very interesting is what you can see here is the buying power. So in other words, the hasty trade will ask you only 23 as a kind of margin, while this is nothing else than the maximum loss, more or less. So let's say we make an example here. We are trading with one call and one put, or let's say calls and puts. So actually, hasty trade would ask us just a margin of $23. Let's say if we would multiply that by 10, so let's say we would do it now 10 on each side, while the margin would be $230. So in other words, this is a really interesting thing that you can actually do quite a lot of options, and the margin is just really small. So you can see now, this is the initial we did on the 30th of May, expiry 16th of June. So let's do now take a look how it was then in about 10 days. So here we see now the Iron Condor on the 9th of June, and you see that the XLF has really come up 3%. I mean, that was the price on the 30th of May, and now we are 33.10, as you can see here. So it's always that what happened to my spread, which was the 32, as you can see here, the option, or let's say the price, is already in the money in a way that it's already overpassed the two call options. In other words, this strategy didn't work very well. The price expectation was a bit too strong, as I expected, and not that much. So at the moment it would be currently a debit of 36, which you can see that would be the case if I would now close the positions. So I would have a loss of 0.08. But what's maybe very important is even the call options are now heavily in the money. You will not have this kind of debit of 50 as you can see here. The important thing is that there's always till expiration there is a difference. Now when you look here, these two numbers 0.77 and 0.36, so actually there is a difference of, I would say now 41. So in other words, it's still a bit far from this kind of 50. That is because this option is still for another week, and then I think it's important to see that actually you may wait now, because who knows, in 1 week this XLF could go again below 30. But what you can see now right away is the put side, which are here, they are both worthless. So in other words, that makes no sense. Now you could tell me maybe to close it down or just leave it worthless, because you can see they are so far, and within 1 week I hardly imagine it will go from 33 to 31. Well, if there would be another banking crash, yes, then it would be possible. But I would propose following idea, as I will show in my next screen. Well, as of 9th of June, I have decided that the put option, those two put options, I will leave them worthless, but I will sell an additional put 32.50 at 10 cents, as you can see here. Well, it's because now when you are at 32.5 on the put side and the call side, so again, only one side can be executed. So you better take now this 10 cents, which actually increases your credit from 28 to 38. So my maximum loss would be only 12. So this is now what I do as a follow-up for just 1 week, because I say to myself, well, as I said, now it seems that this index is quite strong around 33. It hardly will go down. Let's sell a put option in order to get a 10 additional one. And who knows, maybe if the index will be around maybe 33 or 32.90, I can close the call position maybe with a credit of 40. So probably I would be more or less break even, and this is what I'm looking for, because obvious that the strategy hasn't come out as I wished for. But as you see, as a follow-up, I just try to maybe minimize the losses of this strategy. We take a look on the other strategy called short strangle. To explain, this is nothing else that you sell a call and a put with different strike prices. If you would use the same strike price, then it would call short straddle. But a strangle is nothing else than here you're trying to sell a put a bit on the lower end and a call on the higher end. So you can see at the price on the 30th of May was 32.08. So more or less, when you look here, I get more or less the same prices on the put and call side. If you add these two amounts, you get 0.66. That is what I said to myself. That is working, because I was thinking of a kind of narrow range. Because if you add now this, let's say if you subtract this 36 from 31.50, you get 30.84, or you add this 66 to 32.50, so you get 33.16. So this is my range. I mean, whatever is in this range, I will have a profit, or at least this break even. When it goes out of this 33.16, okay, there would be a loss. Here again, very interesting is the buying power. The margin is 585. So again, this is maybe roughly 20%, but again, it's on the put or call side, because it's always the system will tell me there's only one buying power, either on the up or downside, but not on both sides. So as you said, with an amount of $3,200, you just have to deposit 585. Definitely interesting, but again a bit dangerous that you would say, okay, then I can do a ton of short strangle, but you should always realize that you should have a deposit, or you should have at least some money around to cover any possible losses. So far so good. We look now how was the development of this strategy. To the Iron Condor before, the short strangle didn't work out very well so far, because you can see the price of XLF went up from this 32.08 initially to 33.14 on the 9th of June. So just 1 week ahead of expiration. My position is now, as you can see, 0.79. I mean, remember I received 0.66, and if I would close now the position, I would have to pay 0.79. And what's very important, this actually comes all from the call side, because when you look here, the put side is completely worthless. I mean, again, nobody expect that within 1 week we will drop again to 31.50 from this currently 33.14. So the put option is worthless. And that means that now I can think what I can think about it, what I can do, because there's still 1 week to go. So you see as a follow-up the short strangle on this particular day. We are even moving up 33.18. So what I tried to do was to sell one put 32.5. So I moved up from 31.5 to 32.5, and I get about 10 cents. that I can increase my credit from 0.66 to 0.76. Thus, the break even would come now up to 33.26, which is just an inch a bit lower than what we are. Here we are a bit lower than what would be the break even. But I have still 1 week to go. Hopefully, it may be looking that this comes a bit down. So at expiration, either I would have to close this position here, the call side, with probably a credit around 50, depending what is the closing price. This one would expire worthless, this put, or I could do a rollover. I mean, I would roll over the spread here into 1 or 2 weeks, like I show here. That is the other possibility. But I would opt that I would close it, hopefully below this, let's say 60.76. So in other words, I want to have a small profit, and then I would do a new position, certainly having a higher strike of the call option, which is now 33. So I would maybe opt to 33.50, 34, or even 34 to 34.50 as a new jade lizard for 2 weeks. That would be my idea. Well, you have seen these two strategies, Iron Condor and short Strangle. Both were not really working very well because the underlying was just moving up too strong. But I think what's very important to see too, what are the follow-ups? What can be done in order to minimize the loss? And I think this is what is important as a trader to act and maybe just looking for ideas. And the idea in options is always that I say to myself, well, only one side can be executed. So I move up either side, the call or the put, to adjust the strike and get a small income just maybe 1 week ahead. Always then, if I wait till the expiry, maybe 1 or 2 days before expiry, I probably would close the position. And as I said, maybe in the Iron Condor, I may have a small loss in the short strangle. I would maybe have a break even or a small profit. But at the end, very important is for me that I can close the positions and open up again a new one. So in other words, I think both strategies are working. Iron condors are mostly done in earnings situations, because if you don't know, let's say, what Nike is bringing up for earnings, then you do both sides. But the experience has shown me that the move of the stock is sometimes so strong up or down that it really doesn't work anymore with an iron condor. You better make a speculation on one side saying, okay, I believe that Nike will give good earnings, so you do a call spread or a put spread. I would say a put spread if you expect good earnings, and you just go on one side. This is what I would say. An Iron Condor in my case is a good thing on a ETF index, on an index which you expect that it will move sideways. Okay, that's all for today. I hope you enjoyed, and till next one. See you. Bye bye.